Hello and welcome to another edition of the Retail Scoreboard. My name's Wayne Rigney from the Retail Score. The information we're presenting to you today covers the Specialty Retail Index of Australia, capturing thousands of stores across fashion, home and living, lifestyle brands and the like. This information is collected through the clients who use the Retail Score services. So let's get on with the scoreboard. We're looking at the month of January, so January 1 through January 31. Now let's put a little bit of context before we get into the performance. We had fantastic trading through the back half of November and into December. It was a really significant turnaround on what had been a tough year. So how did January fare? Well, wind went out of the sails a bit, I'm afraid to say, folks. Sales down 1.5% on a like-for-like basis. That's the dollar sales amount down 1.5%. As always, there's variability in the underlying data movements. Let's look at the scoreboard. Unit sales down 0.5% because the units per transaction was up by 1.2%. So we're seeing a few more units in the basket. Actual transaction counts themselves were down 1.7%. So again, this story of shopper traffic appearing to be down, but in this instance, the customers are putting more in their more items in their basket. As a result, the average transaction value grew by 0.2%. In the all-important prices area, average sell price was down minus 1% against some reduced discounting. I think more positively, though, is the GP dollars and GP percent. GP dollars rose 0.1%. You've heard me say it before, GP pays the bills. So when we see any growth in that, that's really healthy for the underlying health of the retail business against a modest rise of 1% on GP, actual GP percent. So that's the index. Really just in terms of the actual week, it was that really post, New Year's Eve lull. So that Boxing Day week, which was down on last year, look, just after that period, it was really quite subdued. A little bit of a bounce back through post the Australia Day weekend. When we look at that across state and channel, let's start with the channels. Standalone stores down minus 0.4. Concessions really under the pump there. Online down 0.2. And outlet up 0.9%. So it was really concessions that was one of the numbers that we saw just really weighing in on the index here. Standalone stores, though, down by 0.4%. That's really got to hurt as well. On a state-by-state basis, once again, Queensland was the state that seemed to be able to hold its own, up 1.4%. New South Wales down 4.1%. So that's quite... that was quite a disparity, quite a big disparity there. I don't know whether that's people leaving, more people from Sydney leaving in January than they did this time last year. Maybe some of that overseas travelling bug is back, but that was quite a big drop. So quite variability there in the performance across the states. Look, one of the things, though, that did jump out through the index is this GP percent holding its own. Up again 1 point. Now, 1 point might not seem a lot, but 1 point on billions is a big number. And that 1% increase in GP has been maintained right from, the peak Christmas trading period right through to now. And that's a really positive sign because the sustainability of that GP really gives an underlying message. Number one, discounting continued to be less than it has been literally every week in the last 8 weeks versus last year. And I think there's a really clear implication here, and that is that I think the retail sector as a whole probably had their inventory positions more under control than they did this time last year. Back in the tail half of 2023 and into 2024, there was significant growth in discounting. Discounting was running well ahead of prior years, and that really was an indication that retailer was just too bloated with inventory, didn't have a choice but to move it. I think that has not been the case this year, and I think that underlying level of more effective management of inventory is filtering through to those better GP numbers. So, I think probably better forecasting throughout the year, probably less bullish buying translating to perhaps a more conservative stock position, which means, less discounting required. So that was that's a really good sign, and I think as we come into the next trading cycle and we all wait patiently for interest rates to move back in the favour of the consumer, it's worth remembering that it is still GP that pays the bills, and that GP result that we've been seeing in the Australian specialty industry has really been a significant turnaround. So I wanted to turn our attention this week. We always specialise in and do a deep dive on something, and this time I'm going to look at the growth and disparity and variation of growth through different geographies. This is a big old country that we have in Australia. Geographically it's variable, economically it's variable, and I think it's worthwhile trying to decompose growth down into different constituent parts. Now, fortunately with the TRS index, we collect data at the individual location level and we can roll that up in any configuration that suits. We do have some strict masking rules around our index so that no individual segment will be released unless it's got a minimum of 7 locations in it, and no individual location can be more than 30% of the value of the index, but in that particular defined geographical region. But having said that, given the size of the number of stores we've got in there, we have got some interesting insights, and I want to share those with you today. Now, when we think about geographical splits, I'm just going to look at standalone stores. I'm going to strip out outlet, I'm going to strip out concessions, and obviously online we don't track that. That's a national thing, it's not a state thing, even though customers do shop in different states. So I'm just simply looking at standalone stores sitting in, thousands of locations across Australia. How are they performing? So the first thing we're going to look at is what is the average performance. So I'm looking from July through to the end of January, so a 7-month FY 2025, and I can tell you that the average growth rate of standalone stores over that 7-month period was a modest 0.2%. So any segment that we look at that's north of 0.2% is overperforming the average, and anything below that is underperforming. The first thing we looked at was how are shopping malls doing, which is the higher proportion of stores, versus freestanding locations. And freestanding locations typically are going to be high streets. I can tell you that on average, high streets growth 0.9%, shopping malls just above 0%. So there's your 0.2, and 0.2 being par. So on the face of it, freestanding stores outperforming malls. And that was quite interesting for me. I know they certainly traded very well through COVID, but it seems there is some resilience on the high streets, consumers still engaged in that local shopping. We then looked at cities versus regional areas. So how are our capital cities performing? And I'm talking Greater Sydney, Greater Melbourne, Greater Brisbane versus their regional counterparts, so rural country stores or out of eastern seaboard outside of the major cities. I can tell you that the capitals grew at 0.3%, so above that 0.2% average. Regional stores down by 0.7%. And anecdotally, we've heard this quite a bit throughout the last 12 months that there's a bit of a squeeze on regional, and there could be two things here. There is probably cost of living, but there may very well be a factor of less tourism transiting through regional areas as a result of capital city cost of living pressures. And certainly anecdotally, there's been a lot of press about that particular phenomena. So, the regional centres are just not trading or not having as much joy in driving growth through regionals as perhaps they had seen certainly in prior years. And we've got to remember 2021, 22, 23, Aussies fell back in love with their own country in the absence of the ability to travel overseas. So I think regional centres are paying a little bit of that normalisation of the way people holiday and vacation in this country. Turning our attention then to the actual city centres themselves, How are they performing? Well, overall, they are all performing well above the rest of the market, with the exception actually of Hobart, which is a little bit depressed. Perth up 6.8, Adelaide 6.3, Melbourne up 5, Brisbane up 2, Sydney up a modest 0.8. They've really been performing significantly better than the other benchmarks that we've seen. What's driving this? I am sure there's a large element of corporate Australia reversing the work from home stance and demanding their employees, come back into those CBDs. So a real growth of CBD traffic, particularly Monday through Thursday. I hear Thursday's the new Friday, certainly for socialising in the CBD. Curious as to why Sydney CBD hasn't quite performed as well as others. It could be again that reverse tourism, where Sydney folk are perhaps more inclined to push out further abroad, etc. Not quite sure there, but certainly some really positive numbers across the board that reflect the fact that people are more likely to shop in their capital centres. So interesting there. We've also had a look at the landlords. Obviously where we can identify a particular postcode and there's a mall and the major mall's got a landlord that's attached to that, it's great to see. Were there any standouts? Yeah. GPT as a landlord had a significantly higher growth rate, 4.1%. That's amazing. I know GPT's picked up some various centres in the last 12, 18 months, and maybe they've done some turnaround there. But that's a really interesting number. Of the big guys, Westfield above 0.2, they're trading at 0.4 on the specialty index. Vicinity down 0.5%, and we'll probably see why in a minute with their megastore Chadstone not doing as well as perhaps it could be, or Mega More, I should say. Independent landlords doing pretty well. They're bang on at 0.2%, so not quite where Westfield's at, but certainly not underperforming. And again, probably reflected by that high street number we saw, where we've got more independent landlords through those cycles. So interesting to see those results. And then the final piece of the index is the postcode level reporting. It's a new thing we're releasing here. Going to be really popular with people on the real estate side of retail. Doing lease negotiations and the right. So there's dozens of postcodes that we can now report on. I just looked at some of the biggest ones in terms of physical store numbers, and there's some really interesting variation here. The best performing malls out of the larger malls have seen growth up to 10%. So Carring up almost 10%. Doncaster up 7%. Pack Fair 4.5%, 5%. Indooroopilly trading very well, and that's some of that Brisbane story. Chermside trading well. That's all that Queensland story that we've spoken about consistently over the last 12 months. There are some on the other side of the equation, big malls that really are not performing as well as perhaps their landlords would appreciate. We're showing Chadstone, for example, down 3.8%. That's a big decline. Bondi Junction has fought its way back to a 3.4% growth, and that's coming off a really tough start to the year where I think July and August, it was still dealing with the aftermath of the incident that took place there back in April of 2024. Miranda, Parramatta, Westfields, East Gardens, Penrith, all just a little bit off the money from a specialty retail index based on the data that we have. So, what does that tell us? It says growth is not is not being evenly experienced throughout the Australian retail landscape right now. And there'll be many variables that are coming into play there, including things like, I visited East Gardens. I know that East Gardens, for example, had major works going on with their escalators and the like, which certainly would have affected the shopping habits of some of the consumers there. So there's always, little micro reasons that'll influence the performance of a particular postcode or even region. But I think the broader perspective is that we are eking out a modest growth in what are still tough trading conditions, and yet within that, there's nuggets of really positive growth and some really challenging retail environments within those. And I was quite surprised to see such large disparity in the performance of individual postcodes across our index. I'm sure those numbers will morph and change as we have more clients coming into this index. And I'm sure that, like anything, these malls ebb and flow over time as they go through their various development cycles. So there you have it, folks. Another month of the retail index done. Just a reminder that this index is available to non-TRS clients. If you're a retailer and would like to be able to access this information, please reach out to us through our website, www.theretailscore.com. Hit us up on the contact page and we can connect with you and share how you can access this information. Until next month, happy retailing. Bye for now.